buyers. And what's the risk of technical obsolescence in those fixed assets as well too. So lots of questions and no easy answers, but that's kind of what we bring consultants in to do. So the receivables, I kind of talked a little bit about this. The inventories, when we value these things, we want to value them as the sum of the replacement cost of the assets. So what would it cost a new owner to go out and buy those assets in the condition that they're in? So we want to try to value those not at book cost, not at what the original or book value or original cost, but what's the replacement cost of those things. Fixed assets, kind of the same thing. Don't start with the original purchase price. Yeah, one way that we can look, some fixed assets have nice secondary markets. Construction equipment, for example, has a good secondary market. So to the extent that those markets exist, we can look at the values of similar equipment. Insured values is a good place to start if you want to kind of get an idea of what your fixed assets are worth. You can look at insured values. There are some little mathematical tricks that we can do. We call the equivalent annual cost. So there are some other ways we can look at the value of the fixed assets, but it's nice when we have markets, but it's not always the case. I've got some experience with a business that had some very, very unique fixed assets. There was no market for it, and so just kind of have to. I think we use the equivalent annual cost method to try to figure out what those things would be worth. The intangible assets, the big intangible assets with these firms that are not ongoing concerns, I think, this is probably the biggest one, venture-specific knowledge. So, and I can speak to this firsthand because my partner Jim and I kind of went through this exact dialogue. Oftentimes, the business owner has this knowledge in his head or her head that is the value of the business, right? So how effectively that knowledge is transferred to a new buyer, a would-be buyer, makes a huge difference in how that company is going to be valued. Is there a process in place to transfer the knowledge or not? And oftentimes, when there's not a process in place, you see these earn-out agreements where the current owner agrees to stay on for some period of time to help with that knowledge transfer. So to the extent that there's something in place to be able to transfer that knowledge, that's value enhancing. Brand names, a brand name simply gives you some pricing power. It's the power to charge a higher price than everybody else would. This is pretty tricky how you value these things. There's really no good way to do this, but we can look at firms that have some what we perceive to be brand equity and compare them to firms that don't, and then take the difference and try to say that that's the value of the brand. So that's kind of a tricky balance to figure out what those are, because oftentimes the brand name is wrapped up with other competitive advantages, so you really can't isolate the value of the brand name. Customer lists, this is another big intangible asset that often transfers, especially for professional service firms and stuff like that. So how do we value these things? A rule of thumb, and this is just a rule of thumb, oftentimes those are valued at 1 year's revenues. So you can look at, say the company is essentially the customer list. That's what I'm buying if I buy this company. This is true for professional service firms, I think. So I'm buying the customer list. What's the company worth? Well, about a year's revenue is one way that we could look at that. Alternatively, there's some theory out there that says a new owner of a company gets 2 cracks at the existing customer base. So we can value the customer list based on 2 average sales from that customer. So that's another kind of rule of thumb, and there's nothing written in stone there, by the way. If there are no competitors in the local market, it may be more. So anyway. So those are some of the wrinkles when the firm is not an ongoing concern. If the firm is an ongoing concern, things get a little bit nicer. We can use the same valuation approaches that we use for public firms. So we can use this intrinsic valuation and then our relative valuation measures as well. The problems, these are the standard problems when we value private companies, even those that are ongoing concerns. No market values for debt and equity, so how do I estimate the weighted average cost of capital? It gets kind of tricky. The financial statements tend to go back fewer years, have less detail and more holes. And so for those that are in private business owners or consultants to private business owners, kind of know what I'm talking about there. So no public data. Obviously, there's no stock price for a private company. They don't have public debt outstanding, so we have to try to back into estimates of the market value. Shorter history, different accounting standards oftentimes. So public firms are, obviously very tightly controlled about when and what they report. Yes?
As far as stock price, how do you feel about going with, the last trade, even though it's a private company, amongst the shareholders, or using a multiple of the net income?
Well, you can. You can use the multiple of the net income as an approximation for the equity value. The question is, what multiple do you use? And so what's your comparison group? What's your, where are you at in that multiple? So multiples are, a little bit slippery sometimes. I think the better way is to do a discounted cash flow analysis and then try to back out the value of the equity through an intrinsic valuation, and then try to reconcile that with some multiples, just to, as a sanity check. The most recent trade depends on how recent the trade was, right? Market conditions change all the time. So if you went through some gifting or some sale last year at year end, there's no guarantee that that market value is going to be the same this December, right? So you have this spread. And that, we call that a liquidity issue, and I'm going to talk about this liquidity issue in a second. So there's just no liquid, oftentimes, there's no liquid market for private equity.
Thank you.
Yeah. Okay, some other issues, not that this ever happens, but there's oftentimes intermingling of personal and business expenses. It never happens, right? And so, I don't have, from the chuckles, I don't think I have to talk too much about that. And then try to separate out the salaries from the dividends, because at the end of the day, they all go to the owner, right? So what is a salary and what is a dividend? Kind of hard to tell. And it makes a difference in how we value the company. The liquidity discount. This is one of the big problems for private business owners. We can do a discounted cash flow analysis, and if you talk to a business owner and they say, I think my business is worth $2 million. Yeah, it might be worth $2 million to you, and if I look at the multiples, it may actually suggest some range of values close to the $2 million area. However, if you try to sell that, you're probably not going to get $2 million because there isn't a liquidity discount. Private firms are illiquid. And so how do we estimate that liquidity discount? Good guess. Generally speaking, the liquidity discount for private firms is somewhere in the range of 20 to 30%. And that's pretty uniformly applied. So if you ask folks, you're going to say, 20% liquidity discount to the value of the firm. In reality, though, that liquidity discount should vary across several variables, but oftentimes people that do valuation work don't take this into consideration. It should vary across companies, so better companies should get penalized less in terms of a liquidity discount than poorly performing companies. Time when the valuation is done. So if we're in a time of an economic downturn, that liquidity discount may be more pronounced than in times when the economy is doing well. And then the buyers. So who the buyer is actually can affect this liquidity discount. So if I have, liquidity is more important to a person that is a short-term investor or has some short-term cash needs as opposed to somebody that's a long-term investor. So that liquidity discount doesn't hit them as much. So these are things that we should consider. We often don't. Here's a few ways that we can estimate this liquidity discount. The first way, I call it the Wag Method. This is the wild ass guess method. So you just take a discount and you apply it, and that's all you do. There are some more sophisticated ways that we can try to get at this liquidity discount. There have been some academic studies that run a regression model, a statistical model, to try to estimate the liquidity discount. They look at several different inputs. This particular paper, the author looked at the liquidity discount for restricted stock in publicly traded companies. So that's what they had to work with. That's where the data's at. So you can look at some of these inputs to try to estimate the the liquidity discount and say it's some function of these variables. Then there was another study that I actually kind of like this one. So this, in this study, the author looked at the bid-ask spread to say that, that bid-ask spread for publicly traded companies captures some measure of liquidity, and tried to predict the bid-ask spread based on some other variables here. Revenues, whether or not the company has positive earnings, the percentage of cash held to the overall firm value, and then the trading volume, the trading volume to the overall value, which for private companies is zero because there's no trading volume. So here's a little example that I put together of how we would try to estimate this liquidity discount. So assume that we have a firm that's $500,000 value. We do the discounted cash flow analysis, we do the relative valuation, and we think it's worth $500,000. Annual revenues about 1.2 million, positive earnings, and then 5% cash relative to firm value. Using my Wag method, I'm going to estimate the discount at 25%. It's right in the middle between 20 and 30, so that's my Wag. So what I do, I take the $500,000 and take 25% out of that. It results in a value of $375,000. If I use the first regression model that I showed you, I actually end up with a discount rate. A liquidity discount a little bit higher than the 25%, about 29%. So again, that results in a value of about $350,000. And then if I use this bid-ask spread regression, which is, I think is probably the most intuitive and the most easy to apply for private companies, I end up with a liquidity discount of only about 13%. So you can kind of see how those things range. And the value, we're trying to hit a missing target here, right? We had imperfect inputs, but we try our best using the techniques that we have to try to estimate those inputs. A couple final thoughts about valuing private firms. The value that a privately held company will bring kind of depends a lot on who the buyer is. Is it a financial or a strategic buyer? Is it a family member or an outsider? All these things come into play. So when we look at the multiples at which similar companies have traded, we have to really parse out who was the buyer of the firm, because a strategic buyer is going to pay more than a financial buyer, right? So that's kind of the risk of relying heavily on multiples and multiples alone. Sellers can generally maximize the value if they're going to sell to a long-term investor who is well diversified to mitigate that liquidity discount, and who sees the business as an ongoing concern, so independent of the current owner. Valuing private firms for litigation purposes, partnership issues, divorce issues, tax issues, it kind of depends on what side of the table you're sitting on as to where the value is going to come with that. And I think this last point, I think, is probably the most important point that private business owners should think about. And this is often overlooked but never to be forgotten. The owner of the private business always has the option to invest their wealth in publicly traded equities. They can diversify out, right? So there should be some sanity check among private business owners to determine whether the return that they're getting from the business matches what they would get in the market. I mean, there may not be other benefits to owning the business, personal satisfaction, utility stuff, but in a numbers sense, the return that an owner gets on the business should be equal to or greater than what they get in the external market. So, yes?
Good question. For a private company that's particularly young, like a startup, where VCF is so speculative, they don't have positive cash, earnings are really in the nascent stage, where do you go for kind of an intrinsic value benchmark?
Yeah, so when I was doing my MBA, Amazon was just getting started. And I remember, and this was like before the Y2K stuff and everything, and I remember reading stuff about people saying that our traditional valuation models are dead. We can't value tech companies because our models break down. We have to look for inputs. For small, especially tech-based companies, we use different metrics. We can use how much activity was on a website, try to predict cash flows. We have to really look at the business model, but at the end of the day, we should try to put some value on that. Now, that value may come out much lower than what the entrepreneur expects it or hopes it to be, but my job as a consultant is to give a business owner a fair estimate of what I think the value's worth. And, you know, so it was, Amazon was losing money for the first 5 or 6 years of the business, and a lot of money at that. The market still put a positive value on the stock price because they expected at some point that those cash flows were going to turn positive, and largely so. And lo and behold,